So we're going to go ahead and get started. And today's Innovate 2016 Financial Leadership Encore Series is on developments in NFP Governance, Financial Stewardship. We have a guest speaker, John Alfonso from CohnReznick, and he will be presenting today for us, and we certainly appreciate him doing this. He was at Innovate 2016 that we had in April, and this is his encore presentation. We have several thought leadership events that are going on throughout the year. This is, of course, one of them. We have an executive seminar that's actually coming up tomorrow in Boston, Massachusetts from 8 a.m. to 10:30. It's a live presentation on uniform grant guidance. This uniform grant guidance will also be done in the form of a webinar on November 30th, and as soon as we have the details for that, we will provide them to you. If you'd like to attend that, we welcome you. You can go to the website listed below and get information on that or any of the executive seminars that we have coming up. May 16th through 18th of 2017, we want you to save the date for Innovate. Innovate is going to be back at the Mohegan Sun in Connecticut. If you don't know about Innovate, it is specially designed for nonprofit financial professionals. It's the lowest cost of training available, less than Advantage, less than the AUDC. And we have our personal services team there where you can get one-on-one time with them, as well as 6 different tracks and sessions under those tracks. It's a 2-day event, and it is filled with information. CPE credits are available for all of the sessions, and it's a great value. And I'm actually at the hotel right now. It's a beautiful hotel. What JMT does, we are financial technology solutions for nonprofits. We provide technology services, we do implementations, we do training, and we provide support. We come in and we will help assess your needs and find not only the best fit for you with financial software, but we're going to ensure that that software is implemented correctly and that you have the services that you need to get the most out of it. We were founded in 1991, and this is our 25th anniversary. We've exclusively been serving nonprofit community for 25 years. That means we do not sell to corporate America or the rest of the world. We do have locations, we do have clients all over the United States, as well as some in the Virgin Islands now and Canada. So we're reaching out. We'd like to tell you about our new eBook, 21 Questions Every Nonprofit CFO Must Ask When Evaluating Cloud Financial Management Solutions. You can download the new eBook and find more out about it at the website below. And with that, I am going to turn this over to John Alfonso, who is going to let us know more about the governance. John, you have the floor.
All right. Thank you very much, Angela. It's a pleasure to be here today and present again this topic that's of great interest to me, and I hope to many of the folks on the phone. I'd like to start off by giving a big thank you to JMT for allowing me to present today. I'm a big fan of your work, and I really appreciate JMT's commitment to thought leadership for the non-for-profit industry. We share that same commitment with CohnReznick and are proud to serve over 1,700 tax-exempt organizations throughout our 30-plus offices in the United States. So the focus today of our presentation is going to be on financial stewardship. And my objective is to share with you some thoughts about responsibilities for present-day non-for-profit audit committees and how management, internal auditors, external auditors can work together using modern-day best practices and tools to mitigate risk. This presentation is based on what I'm seeing, reading, and hearing about in the nonprofit sector I'll cover a broad array of governance topics, but we'll look through the lens of the Audit Committee to explore some of these topics. Bear with me there as I make the technology work here. All right, agenda is going to cover what some of the traditional thinking is about audit committees and what some of the modern day best practices are. We're going to, I'm going to present you with what I believe the critical tasks are of an audit committee and a finance committee. We're going to share with you information about our 2016 non-for-profit governance survey. At INNOVATE, back in the spring this year, we had our 2015 results, but I'm happy to tell you that we've updated this presentation for our 2016 governance survey. And as part of this presentation, we're going to do a deeper dive into some of the newer areas of focus for audit committees, and those are related party transactions and conflicts of interest, fraud prevention, enterprise risk management, and oversight of technology. And as Angela said, I'll try to get to most of your questions at the end of this session. If I cannot get to them, please don't hesitate to send me an email. Also, we'd be happy to share this presentation with you, which I think you can all download from this site. All right, so let's take a look at what some of the traditional thinking was about what an audit committee should do. I suspect this is no surprise to the folks on the phone. Obviously, it was to oversee the external auditors. For those organizations that do have internal auditors, obviously oversee their work, oversee the financial reporting process, compliance with legal and regulatory requirements, and reporting to the board of directors. You roll the clock forward, and I believe audit committees have evolved. Now their roles are expanded. They include monitoring conflicts of interest, monitoring fraud prevention and detection strategies. Many audit committees are now involved with enterprise risk management or some theme and variation of risk management and assessment, and oversight of technology, cybersecurity, and data privacy. Now, we'll discuss all of these in depth. I've laced in here some cartoons for your viewing pleasure. I hope you enjoy them. And I think if there's a theme in this presentation, it's that audit committees have evolved to be more of audit and risk management committees. So I'm a big fan of the AICPA's non-for-profit toolkit. It's relatively inexpensive and you can download it. And I highly recommend it to you. I provide references to the toolkit throughout my presentation. And the AICPA, I'm sure all of you know, is the American Institute of Certified Public Accountants. In the interest of full disclosure, I will tell you that it has been a long-time client of CohnReznick. And notwithstanding that it is one of our clients, I will tell you that this is an excellent resource for management as well as audit committees. I realize some of you, perhaps most of you, are on the management teams of your local organizations, but I think that these are practices that you can carry over to your audit committees, and I think it also helps you with your own stewardship and transparency responsibilities as officers and members of management of your organization. All right, so here's some common sense guidance about the roles and responsibilities of an audit committee. And obviously, when you are looking to set up a committee, you need to be considerate of the size of the organization, the diversity of the organization's revenues, and the complexity of the financial position and statements, and the geographic footprint of the organization's staff and mission. Obviously, when forming an audit committee, one size doesn't fit all organizations. And we'll talk about this some more at length, but I appreciate, particularly for smaller non-for-profit organizations, how challenging it can be to find good volunteers to sit on your audit and finance committee. That truly is hard work, oftentimes led by members of the board and the management team. So I thought it would be interesting to compare and contrast what the toolkit said member roles and responsibilities were in 2010 versus 2015. Not surprisingly, the 2010 responsibilities were what I shared with you a little earlier about what the traditional thinking is for an audit committee. But now in 2015, and that's the latest toolkit that's available, you could see the items in red have been added to the listing, or I should say modified from the 2010 listing, so that now the interest is more in making sure you understand the qualifications of an internal auditor. An entirely brand new topic is making sure that the committee monitors risk management and the overall governance process. And lastly, the word ethics has found its way onto this listing with respect to the organization's compliance program with legal and regulatory requirements. So greater emphasis on ethics, understanding who your internal auditor is, and of course, risk management. So I think there is an age-old debate which continues today, and that is whether to have an audit committee and a separate finance committee or to combine both committees. And I think with the exception of California that requires two separate committees, I think the decision is largely a judgment call and depends on the caliber of the volunteers that you have available for those committees. I believe the best practice is to have two separate committees, and I'll explain why. So based on what I've seen and read, here is an outline what I believe to be the critical task of a modern-day audit committee. And topping that list is risk monitoring. And that includes making sure that conflicts of interest are monitored and related party transactions are monitored, whistleblower reports are monitored, making sure you understand that there are anti-fraud programs in the organization, compliance with laws and regulations, and enterprise risk management. Now, I know that's a lot to tackle, ERM, and some of the literature out there is very mixed about the success relating to ERM, but I am seeing a great deal of interest today with charities about risk assessment and risk management. And by the way, the literature out there today, there are very strong arguments in favor of setting up separate committees for ERM versus having this responsibility monitored by an audit committee. So there's different schools of thought. Again, I think it comes down to the quality and number of volunteers that you have available. Well, certainly a critical task of an audit committee is to monitor the work of the external auditors, making sure that they're qualified, independent, making sure you understand the audit plan and the audit results. And it's very similar for the work of internal auditors, for those of you that have them, understanding their qualifications and trying to understand and approving the scope of their internal audit plan and reviewing their results. And obviously, an audit committee needs to communicate to the board about what it has observed. So in my view, an audit committee is all about auditing and risk management, whereas a finance committee is more about monitoring, planning, and strategy. I see the critical tasks for a finance committee to be monitoring the application of resources. That is your budget, understanding actual versus budgeted results, and establishing compliance with, making sure that there is compliance with financial policies and procedures. In the absence of an investment committee, the finance committee should be monitoring compliance with investment policies and objectives, establishing and monitoring asset allocations, and approving spending rates. In some cases, finance committees approve significant transactions, they review tax filings, and they obviously communicate to a board of directors. By their very nature, I think finance committees are less independent than an audit committee. And that's why I think it's optimal. It's just a nice check and balance to be able to have two committees. All right, so I promised you I'd share with you some data from our 2016 survey, and we're going to go through this pretty quickly. I'm happy to tell you over 600 organizations responded to our survey, and we're happy to share copies of it with you. Just send me an email if you'd like a copy. So here's some context. The majority of the respondents to this year's survey, the 2016 survey, were broad-based social service agencies and public charities. A little different than in the past where we had a greater mix of higher ed and healthcare. Still a healthy mix of that, but I would say the largest percentage has been the social service agencies. Most of the organizations that responded had revenue between $1 million and $25 million. Interestingly, that's a very large percentage of the clients that we serve. And many of these organizations had a separate audit committee and a finance committee. A large percentage also had combined audit and finance committees, which is perfectly acceptable with the exception of states like California that don't allow for it. Not surprisingly, the majority of the respondents were CFOs and CEOs. One question we like to ask every year is to try to understand what the size of their audit committee is and what were the voting members and non-voting members. And you can see from this chart that the majority of these audit committees had greater than 4 members, and the majority of them also, the members were voting members, with very few non-voting members. You may or may not know that one of the things that I do in my life, which I consider a privilege, is to be a member of the board of directors of the American Cancer Society, and I currently chair the audit committee. And our audit committee has 5 voting members and 3 non-voting members. And interestingly, the 3 non-voting members are, we have 2 that are IT specialists, and one of them is a CPA with non-for-profit reporting experience and expertise. We're pleased to see that most audit committees of the respondents had a financial expert on their committee. It's not surprising, but it was good to see that confirmed. This was one of the more surprising responses to our survey, and it had to do with whether the respondents' committees had charters. And I was surprised to see how many committees did not have a charter. And we really believe at our firm that every audit committee ought to have a charter and ought to have an audit plan for the year, an audit committee plan for the year that covers what agenda items they're going to be covering at the various meetings. There are great examples of charters online. Of course, I'm partial and biased to the American Cancer Society's Audit Committee charter that is available. And I believe the Nonprofit Toolkit also has examples of charters that you can take a look at. All right, so 2 of the elevated areas of focus for audit committees are related party transactions and conflicts of interest. The IRS, as I'm sure many of you know, and the New York State Attorney General has highlighted the importance of strong governance over these areas. Now, I appreciate that many of you may not reside in New York. I suspect a good number of you are either New York charities are registered in New York, so the Nonprofit Revitalization Act may apply to you. Even if it doesn't apply to you in your own state law, I think there are some very good guidance in the Act, and certainly this Act provides excellent stewardship ideas for those of you for which the Act does not apply. All right, so let's get a little bit into the Act itself. The Act defines who a related party is, and it is any director, officer, or key employee of a corporation or an affiliate of a corporation, any relative of an individual described above, or any entity with which an individual described above has a 35 or greater % interest. So keep in mind that for there to be a related party, there really needs to be a transaction. There needs to be a financial interest for the party that is involved. I want to acknowledge and thank Sharon Connolly from Venable, who helped us with some of these slides here today. And you could see we credited this information to them. I am a CPA. I am not a lawyer, so I have no business advising any of you about legal requirements, but certainly I am sharing with you best practices that we're seeing. And certainly to the extent that you tinker with policies about that may affect bylaws or that may affect how you monitor some of these transactions, I think it's wise to reach out to counsel. All right, so as you know, not all related party transactions are bad. Wouldn't we all like to have one of the directors give us a piece of appreciated property for free? Well, that's great. It's a related party transaction, but certainly it's very beneficial to a charity. The key here is that related party transactions need to be fair and reasonable. They need to be disclosed to a board of directors, and they need to be approved by independent directors of an organization. So key takeaway for me is to make sure that your audit committee or some other independent body of the board is involved with related party transactions. And make sure those directors are independent. So there's some additional requirements. If the related party has a substantial financial interest in the transaction, law doesn't define what that is. I guess we'll all know it when we see it, but it would be a material transaction, and you need to consider alternatives to those transactions. They need to be approved by not less than a majority vote of the directors or a committee of members present at the meeting, and you need to document the basis for approval, including the alternatives that were considered. It just pays to be very careful with related party transactions. They can be more trouble than they're worth, as I'm sure many of you know. So a little bit about conflicts of interest. All related party transactions, I think, are conflicts, but not all conflicts need to be related party transactions. An example could be that the CEO of your organization sits on the board of another organization with a similar mission. Yes, it's a conflict, but it may be a very good conflict for the organization. I don't think there is a charity I know of that doesn't have a conflict of interest policy. So I think it's wise for all of you to have good, robust conflict of interest policies and to document procedures for detailing the existence and resolution of conflicts and procedures for disclosing, addressing, and documenting any of these conflicts that may give rise to related party transactions. Keep in mind that in the New York law, and the best practice of the day is that the adoption, implementation of, and compliance with conflict of interest policy must be overseen by independent directors on the board or a designated audit or other committee comprised solely of independent directors. At ACS, the American Cancer Society, we've wrestled with how often and how much the independent directors should see with respect to conflicts of interest. We've decided that the audit committee chair, yours truly presently, should see all conflicts when disclosed. Routine conflicts are approved at the next audit committee meeting, and for larger, more significant conflicts, the society would convene a special meeting of the board or the audit committee to get a conflict like that approved. So we polled our participants to let us know who they are getting conflict of interest disclosure statements from, and not surprisingly, they're getting them from most board members, from members of management. I would have liked to have seen more responses from all of the above, since I think it's wise to make sure that vendors are disclosing whether there are conflicts that they may have with your organization. Not surprisingly, the majority of the respondents' audit committees were monitoring conflicts of interest. I suspect those that weren't had some other committee of the board, or at least I'm hopeful that that's the case, monitoring them. Okay, fraud. We could talk about this for days and days, right? But let me hit on some of the high notes about this expanded area of focus for modern audit committees. And I'll tell you, I've become aware of more frauds in the past 5 years than in my previous 25 years in public accounting. I think what's going on is that in desperate times, people do desperate things, sadly. So you've all read about the many scandals. I think those scandals have basically charged up the public's interest and the regulators' expectations about preventing fraud in non-for-profits, particularly those that they are donating to. Here's a definition from the auditing standards about what frauds are. And Chapter 9 of the Non-for-Profit Toolkit is titled Fraud and the Responsibility of an Audit Committee, an overview. The toolkit advises that an audit committee should understand if an entity has a strong internal control environment. The audit committee needs to be prepared to aid in the discovery and investigate and report fraud to the board of directors. And an audit committee should ensure that the organization has implemented an effective ethics and compliance program that is tested. Now, of course, you know, this is a collaboration with management. A good, healthy partnership between management and an audit committee or a finance committee is very vital to the success of your stewardship and governance policies. So this next slide shares with you some facts about detecting fraud, and I really like the data that's available from the Association of Certified Fraud Examiners, and they provide this data free on their website. And in their 2016 report, which is very similar to 14 and 15, they said that the frauds reported to ACFE in 2016 lasted a median of 18 months before they were detected. Tips were consistently the way most frauds were detected. Organizations with hotlines were more likely to detect a fraud. And survey participants estimated that the typical organization lost 5% of its revenues each year to fraud. The median loss went up from $145,000 to $150,000. They also advised that you need to be aware of some behavioral red flags that are often associated with fraud. And that's people living beyond their means, people having financial difficulties, unusually close association with vendors or customers, and excessive control issues. Here's a chart that shares with you how some of these frauds were detected. Let's speak a little bit about whistleblower policies. Here's some guidance from the New York law. keep in mind that the IRS is also very interested in whether you have a whistleblower policy. And many nonprofits have terrific whistleblower policies. But what I find is that oftentimes they have flawed whistleblower complaint resolution systems. So there really isn't a well-advertised complaint resolution process. Employees don't know where to go. And I really think that's the thing to spend time and effort on making better. The policy in of itself won't do very much good. It's really getting at the problems when they surface. Well, Chapter 9 of the toolkit provides guidance on compliance reporting, anti-retaliation procedures, and whistleblowing report tracking. I find it interesting that the New York law puts boards on the hook for administration of the policy. You could see here in about the middle of the page that a requirement that an employee, officer, or director of a corporation be designated to administer the whistleblower policy and to report to the audit committee or other committee of independent directors, or if there are no such committees, to the board. So certainly with respect to the New York law, the board needs to be aware of some of these complaints. So not surprisingly, most of our survey participants answered that they did have a written whistleblower policy in their organization. I wonder if the folks that answered that they had no intention of developing a whistleblower policy were kidding when they answered this question. It's surprising that in today's day and age you wouldn't be interested in having one. So here we tried to find out how often an audit committee monitors whistleblower complaints, and it was nice to see that a majority of the respondents said that they were monitoring these complaints on an occurrence basis. Hopefully, for those that said never, there was some other committee of the board that was monitoring some of these complaints. All right, so the next area of expanded emphasis for audit committees is that of oversight of technology, cybersecurity, and data privacy. To say cybersecurity is a hot topic today is a gross understatement. I wonder how many times that word is uttered in the media today. Another cartoon for your viewing pleasure. And we're in an era where technology has become vital and inseparable from our day-to-day work. A good friend of mine, Joel Lance, wrote an article in the November 2014 Journal of Accountancy that many believe that managing cyber risk can no longer be delegated to someone other than the person or groups responsible for the business. In a non-for-profit organization, I believe that responsibility falls squarely on the shoulders of, or I should say ultimately on the shoulders of a board of directors. So I believe that when it comes to technology governance, it's all about asking the right questions. I'll share with you what some of those ought to be. The next slide you can take a look at later on. It's a survey that was done by the AICPA of what some of the top technology concerns were in 2014. I suspect many of you have some of these same concerns in your organization today. Our respondents told us that cybersecurity is among the top risk in their organizations. You could see that the majority of the respondents, over 70% of them, thought that they were among the top 10. You know, today's threats are getting, I would say, far more frequent and far more complicated, as this chart illustrates to you. And many of you may have heard the kind of running joke among IT professionals that there are two types of companies. There are those that know they've been hacked, and there are those that have been hacked and just don't know it yet. I hope that's not your situation. Here are a handful of old but very significant breaches that occurred. So today's reality is that 1 in 5 organizations have experienced a cyber attack. It takes about 8 months to figure out what's happened. There are about 2.5 billion of exposed records in the last 5 years, and 62% increase in breaches in 2013. Somewhat stale data, but I would hate to see what that percentage is today. And from January 2012 to June of 2014, 75% of the reported data breaches occurred at small and mid-sized organizations. So what does all of this mean to a board of directors or to an audit committee? Boards need to be involved because of the consequences of what can go wrong. Boards can't assume that cybersecurity is entirely handled by management or the IT department. Here are some of the questions that boards ought to be asking, and really encourage you to encourage that dialogue among your board members. I think we see technology issues existing significantly in some non-for-profit organizations, perhaps not those that are wise enough to have JMT as one of their advisors, but we see them in non-profits. Oftentimes it's because they have weak standards, they don't focus on perimeter security, and maybe topping the list is that the security awareness of their professionals is just weak. We really encourage nonprofits to have routine security training, and quite honestly, annually is probably not all that infrequent. So to avoid being the next victims, I have the good fortune of working with folks that do this for a living, that is, advise others about some of these types of controls. And you really ought to know what your information assets are. You ought to do the basics right, such as patch management, good authentication, perimeter security, malware and antivirus programs. And don't forget to back up, to monitor your system's activity, and periodically do vulnerability assessments. And then once you've had a breach, make sure that you have a response plan. So here's some interesting data. I will get through it very, very quickly here, but we've tried to find out whether folks are planning to spend more or less on data security. And in 2015 and 2016, roughly a third of the participants said that they intended to spend more than in the previous 12 months. Of those that intended to spend more, the average spend was somewhere between 1 and 10%. All right, so here's another one of those areas of expanded interest for audit committees today, and that is enterprise risk management. And this is another topic that we could spend weeks talking about. Some organizations have spent years trying to implement a process, mostly in the for-profit world. And as you know, or you may have read, some public companies believe that they really have not gotten the ROI that they expected from such a process. So I am a believer in enterprise risk management. For it to be successful, particularly at smaller organizations, it needs to be scaled for that organization. And whether you call it enterprise risk management or some version of a risk assessment, some interest in risk, quantifying what those risks are, needs to be present in the boardroom. And I think the discussion needs to find its way more and more into the board agenda. So whether it's a full-blown version or a skinny-down version of ERM, directors and managers need to know what their top risks are in an organization. You also need to understand what your tolerances are for those risks, and whether there are mitigation strategies that are in place. Here's my view about the basics. You need to understand of risks. You ought to try to bifurcate them into two broad categories: board level risk, which tend to be more strategic, enterprise-wide issues, and operational and management level risk. An ERS, or a risk assessment process, needs to identify what the board's tolerances are for some of those risks. Not all risks are terrible. Sometimes you need to take risks to advance your mission. But you ought to come up with some metrics to measure what exposures there are for taking on some of those risks. And you need a robust system of reporting on those risks. I encourage you to look at the toolkit. You'll find some very good data in the toolkit about enterprise risk management. Very quickly, here's a slide that describes whether our organizations, the organizations of the participants, had an annual risk assessment process. It's interesting that about 40% of the respondents did not conduct any sort of annual risk assessment. And cyber and IT were relatively low in terms of conducting such sort of studies. And I was also not surprised, but I am disappointed that enterprise-wide risk assessments, or the equivalent of ERM, had a very low response rate. We also tried to see if organizations had performed cybersecurity vulnerability assessments. It's too bad that the majority of the respondents had not gone through such an assessment. I suspect this is more typical of larger organizations. Truthfully, one takeaway from our survey was that there seems to be an increased interest in good governance on the part of the respondents and in minimizing risk, particularly cyber risk, but we didn't see an appreciable increase in risk minimization activities and expenditures. So we hope that that improves in the future. Here's some guidance from the toolkits on what a board ought to do with respect to enterprise risk management. Won't cover them in detail. I just want to emphasize that enterprise risk management is an enterprise-wide activity. The board and management should be involved. There's some guidance here, again from the toolkit, about how you can involve the internal auditor in such a process. And I think you can take a look at these on your own, and I firmly believe that internal audit can be very valuable in the process. All right, I encourage you to look at some of these slides on your own. I wanted to make sure I cover, at least briefly here in the next 2 or 3 minutes, some information about the new non-for-profit financial reporting project, which has now become promulgated guidance on the part of the FASB. I'm sure many of you are aware that there is a new standard now for financial reporting for non-for-profits. It's not an overhaul of the current model, but it is an improvement with respect to some classification issues and some of the disclosures about financial performance, cash flows, and liquidity. The FASB's goal was to help nonprofits tell their story in a better way. So this chart, in my view, really gives you the view from 30,000 feet. Some of you may be familiar with this new standard. Some of you may not. Fear not, you're going to have time to implement it. Our firm certainly will be rolling out webinars and training for our clients, as well as thought leadership materials to make sure they understand what this new guidance is requiring. In a nutshell, in a very quick nutshell here in light of the time, I'm sure you've all heard that now you're going to move from 3 net asset categories to 2. You'll have one category with donor restrictions and one without donor restrictions. There's going to be expanded disclosure requirements about designated net assets as well as restrictions on net assets. Fortunately, you're going to be able to net investment expenses against investment returns. You will be required to prepare a statement of functional expenses. Those of you that are not health and welfare organizations, voluntary health and welfare organizations, did not have to do that. But now the entire nonprofit sector will. There hasn't been much movement on operating measures. If you do use an operating measure, you're going to need to define it. What is very interesting is that there's going to be some disclosure about liquidity now in your footnotes, and that's new to all non-for-profit organizations. The FASB and many stakeholders are interested in trying to gauge what liquidity is. And the statement of cash flows, the good news out there is that there is no requirement for a direct method cash flows. You can still use the indirect method. They did break this down into 2 phases. They're going to keep looking at operating measures, that is carving up the statement of activities so that you can get to an operating measure. And they're going to look at the categories in the statement of cash flows in the future. The only thing I will share with you is that the effective date is going to be for most organizations sometime in 2018. So you'll have some time to hear more about this. And thank you for your attention. Let me pause there. I'll turn it back to Angela and see if I can answer any questions.
Thank you, John. Do you mind going to the slide just with your contact information really quickly, just in case anyone needs to get a hold of you?
My pleasure.
Thank you. I just want to make sure that they can contact you if they have any questions following this. So I'm going to take over the presentation.
Mm-hmm.
And if anybody has any questions at this time, please feel free to type them into the questions section, and John is happy to answer them. Again, there was so much information to cover, and thank you, John, so much. You did a fantastic job of trying to get that information in an hour, and I know that it's a lot, but if anyone has any questions at this time, we're happy to take them. Okay, there's no questions coming up. John, is there anything else that you want to cover or you want to share with us? And then I can let you know if there's questions.
No, thanks again, Angela, for the opportunity today. Really appreciate all the good things JMT is doing for its clients and for thought leadership. Really appreciate partnering up with you to do this presentation. I encourage those of you that are on the phone to not hesitate to reach out to me if they have any questions about corporate governance, audit committees, finance committees, how to interact with internal and external auditors. That's what I like to spend my time advising our clients about.
And likewise, John, I'd just like to say that JMT certainly appreciates our relationship with CohnReznick, and more specifically you and your team, and everything that you help bring to JMT, and for doing this webinar today. So with that, we'll give one more opportunity for questions, and if there are no others, then you can contact either myself or, again, a member of the CAM team, or John directly, and we'll be happy to answer them, and we will give you back 7 minutes of your day. And thank you very much for attending today. Have a good one. All right,